We went through this on the last one. We came up with this total, $23,372.76. Now, if you look at the 1040, well, let me make sure I've got the right one. Okay, if you look on the 1040, the standard deduction is $11,900. Obviously, a deduction gets subtracted from your income, so it lowers your tax bill, right? So you want the largest deduction possible. So they can take the standard deduction of $11,900, or they can take the $23,000. It's a better idea to take the $23,000. That's going to lower your taxes. The Schedule A, yeah. Let me back out of it. So you do each individual section, right? And that gives you these numbers here, and then you just add all this up all together. So you just add it straight down, and you get this. Does that make sense? Adding it straight down doesn't make sense? Okay. The rest of it didn't make, okay. So I'll review this again real quick. We took their medical expenses that came from the notes. So on that particular sheet of the notes was, hold on, your page of the notes, it looks like this. And there's their medical expenses. But they had insurance, so they only paid 20% of that. So you take 20% of that, they paid $3,760. This is how much they paid. Okay. So medical expenses was $3,760. Their adjusted income was that $77,012. That tells you exactly which line 38 on the 1040, which is right here. So we put that number there, and then you multiply it by 0.075. That gives me $5,775. Now, to deduct medical expenses, they have to be the amount over that. So whatever this amount is, you can only deduct the amount over that. Well, they paid less than that in medical expenses. There is no amount over that, so they can't claim any medical expenses. Okay, so that's how that became 0. Then on that next square, we have their state income tax and real estate tax and mortgage interest. So income tax goes here. And you have a choice. You can do income tax, state income tax, or if you live, like say here, Florida, we don't have a state income tax, you can do the state sales tax, which means if you keep all of your receipts all year long and total up all the sales tax, you can deduct it. It just needs to be enough to make it worth it. You know, you want the final number to be greater than the standard deduction. So if you're single, which anybody married? Nobody's married, right? Okay, so single, your deduction is $5,950. So you would need this total to be more than that to make it worth doing this. And that's the total for everything. So your medical expenses, taxes, interest, charity, all this stuff. So if you have other things, medical expenses or casualty, theft, loss, or things like that, then it's worth saving all the receipts to go ahead and add the income tax or the sales tax in there. If you don't have medical expenses or any of these other things, then it's not really worth saving the receipts because most people don't pay over $6,000 in sales tax in a year. Right? I mean, do you guys know about how much you spend on sales tax in a year? So it depends on what county you're in, but it ranges in this state between like 6 and 8% of your total purchases. So in order to get to be more than $6,000, hold on a second, let me pull up my handy dandy calculator. Let's say we'll just use 7 cents. You'd have had to spend $85,000 shopping in the year to get $6,000 worth of sales tax racked up. So that's why I said you have to have these other things to make the sales tax really worth it. But they're doing income tax, so they had $33,298 in income tax, and then they also had real estate tax. Now with those, you just add them together. So this plus this gave me that. Okay. Then they had mortgage interest. Let's So when you pay your mortgage, you pay interest every year, and the bank sends you a 1098 that tells how much interest you paid. And that can go on here. Then we had the gifts to charity, like straight money, and then items. So you know how they tell you, like, donate your car or boat or RV for charity or whatever? That would go under items. If you donate clothing or household items or anything like that to, like, the Goodwill or Salvation Army, that can go down here too. If you give any cash donations to any charity, that can go up here. The only thing is, you have to, if any one charity, just like the total here 987, that's okay. It can be bigger than 250. This is saying if any one charity got more than $250, there's another form you have to fill out. And then same here, if any one charity got items worth more than $250, there's a thing. And if it's over $500, so like let's say you donated your boat to one of those charities, they're going to give you a receipt and it's more than $500, that's when you have to attach this form. But in our notes, it says that the highest amount they gave to any single charity was 100 or 120. So we don't have to worry about those, yeah. No. On the 1040A, you're not allowed to do a Schedule A. You're only allowed to do a Schedule A with a 1040. So on that particular problem where it's saying to do a 1040A, they're not itemizing their deductions. So they're not going to deduct that state income tax. It's just extra information, yeah. And that's, a lot of people choose not to do that because, again, like I said, in order to be worth itemizing, you want the largest deduction. So if you're single, your standard deduction is $5,950. I kind of crossed through it so you can't really see it, but it's $5,950. If you're married filing jointly, it's $11,900. And if you're head of household, it's $8,700. That's your standard deduction. That's how much everybody's allowed to take. Itemizing deductions is only if you have things that qualify that will be a bigger amount than that. So like their state income tax on that one example that you just said, it's not high enough to make it worth them doing this. Their standard deduction is going to be higher. Does that make sense? So you have to choose. You choose whether you want to itemize your deductions or not, and you base it off of this number. If your itemization is more than $11,900, or if you think it will be, you go ahead and figure it out and see. And then you take whatever number's bigger. Let's say you thought it would be more than this, and it ends up being $11,500. Well, you added all those numbers up or whatever, but then you just go, nope, never mind, and then you take the standard deduction. You take whatever number's bigger. Does that make sense? Okay. That's, yeah, add them together. Yeah, when you file jointly, everything gets added together. Income gets added together. Like if you guys had separate bank accounts and so you got two different bank interests or whatever, it gets added together. All of the totals have to be both of you. Okay, so we're going to subtract 5363924 minus 5363924 minus 11,400 gives me $42,239.24. This is what they're going to be taxed on. This is how much the income, this is all of the adjustments on the income. And we're now going to use that income, taxable income, to determine their tax. That's this line, tax. For this line, I'm going to put a little note on here. This is from tax table. tax table that we have. We're looking for 42,239. Sure. $42,200 to $42,250. Here's their tax right there, $5,464. Yeah. Not this one. Okay, so we got their taxes, $5,464. Now, alternative minimum tax, we're not going to worry about that. So add lines 44 and 45. So that's their tax. Now we have tax credits. And if you look on here, the O'Sullivans both work, and they pay for child care, so they can get a tax credit of $780. So if we look on these lines, here it is, credit for child and dependent care expenses. So that was $780. That goes right here. And then the next thing is they installed some energy saving items and can receive a $133 tax credit for that. If we look on here, residential energy credits, $133. So if you install solar panels in your home, you can get a tax break for it. If you buy energy efficient appliances, you can get a tax break for it, things like that. Okay, so what we do is we add those two together, and they've got $913 in tax credits. Now tax credits, it's like it's already paid. Okay, so basically the credit's saying, oh, you already paid $913 by this stuff over here. This you didn't really, but it's a credit, so it's like you did. So you subtract 564 minus 913, or 5464, not 564. And their new tax bill is 4551. Okay, so this is how much tax they owe for the year. Okay. If they're self-employed, or they had unreported Social Security or Medicare tax, any of these things, household employment taxes, first-time home buyer credit repayment, there's all this stuff here you would have to just like read through. We're not going to be doing any of those, so we'll just continue that as 0, and we'll just bring this total down. Okay, these increase your tax, these lines here. Well, not B, but the rest of them increase your tax. So it's like extra tax. Like if you're self-employed, you have to pay extra tax, or if you are household employment taxes, that's if you employ people in your home. Okay, so their total tax bill is $45.51, and now we need to look at how much tax did they already pay. Okay, so did I not? And on the homework problems in the test, this is not happening, but we'll just say from their W-2s, their total tax withheld was $12,321 together. Okay, so I forgot to put that in there. I don't know what I was thinking, but we'll just say that happened. Okay, so they paid from their taxes $12,321. Okay, earned income credit for a family of 3, you have to make less than like $45,000, so they're not going to qualify for that. We're going to ignore all of these, so their total payments was the $12,321. They owed $45.51. They paid $12,321. which means that they're going to get a refund of $7,770. Okay, and the reason they'd get the refund this high is because of these deductions up here. If these deductions hadn't happened and lowered their income by that much, their tax bill would have been much higher. Plus these credits, this $900 credit helped a lot too. Okay. All right, so we've got the parents. We've got the parents, we've got the child, we've got the check marks. There's 2 of them and 1 child, so that gives them 3 exemptions total. And then we want to look at their wages, salaries, and tips, okay? Donald's wages, Barbara's wages. So we need to add those 2 things together. So 57,890 plus 49,800 gives us a total wages of $107,690. Okay, so that goes right here. Okay. Then the next line is taxable interest. So this is bank interest. They received $556 in bank interest and $412 in stock dividends. Now I'm not listing separate companies here. So you only have to fill out a Schedule B if there's more than 1 bank or more than 1 stock, or if it's over 1,500. So I don't have to fill out a Schedule B because I don't have separate banks, like I don't have separate companies. So my bank interest is $556. That goes right here. And ordinary dividends, this is stock. That goes right here. Okay. They did not have any other sources of income listed here. So we don't have to worry about any of these. So we're just going to total these 3 numbers to give our total income. 556. We're doing number 44 from the homework. Okay, so we add 556 and 412 to 107,690, and we get 108,658. Okay. Now, if we look on this, it says that Donald's a piano tuner and Barbara is a car dealer, so there's no educator expenses. And we don't have any, in the problem, any of these expenses listed. Remember, this is a maximum of 200. Don't forget that on the educator expenses. But we don't have any of those, so this whole section would be left blank. And we just bring down the income. Any questions so far? That amount gets carried to the back page and just gets put again in the top line. And now we're going to itemize our deductions, or at least we're going to see if that's the way to go. So we need to get our Schedule A out. Okay. And we're going to start with medical. Medical expenses, they had doctors and dentists. So $1,770 and $2,300. So I'm going to add those 2 together. And that gives me a total of $4,070. Then I need to bring their income, which was $108,658 right here, and then I have to multiply that number by 0.075. $8,149.35. 4,000 is less than 8,000, so I cannot claim any medical expenses. So far, okay? All right. The next thing they had were taxes. It doesn't actually say what kind of taxes, so we're just going to go ahead and do it. State taxes, $7,600. And then interest paid, we're going to assume that that's mortgage interest because it's not being specific in the problem. Okay, the taxes, they only had the one taxes, so that goes here. The interest paid, they only have the one example of that too, so none of this gets filled out, so that goes there. The next thing on the problem, they have cash and used clothing, so 270 and 200. 270 in cash, 200 in clothes. Add those together. Then the next thing on the list, they have a casualty and theft loss of $12,000. Okay, that right there is enough to make it worth itemizing because the standard deduction was $11,900. This is $12,000. That already put you over it. Okay. Then we had job expenses of union dues of $400 and tax preparation fees of $175. We add those together and that's $575, and then we have to bring the income back in again. And we multiply it by 0.2 this time. And it's $21.73. Well, $575 is way less than $2,000, so they can't claim any of those either. Okay, now this form is pretty much done. All we have left to do is add it up the whole way down. So I add these numbers together. And I get $25,360. And they have a choice. They can take their $25,360 deduction, or they can take $11,900. Which one would you take? $25,000. Awesome. Yes. So we put that here. Okay. We take that $25,000 out of their income, and that brings their $108,000 income down to $83,298. Exemptions, they had 3 people, which is $11,400. So we subtract that, and then that brings our income down to $71,898. Yeah, oh, sorry, yeah. I forgot I zoomed out. Okay, so we subtracted their itemized deductions. That's our new total. We multiply times 3 to get the exemptions. We subtract, and now you have $71,898. And here is where we have to go to the tax table again. Okay. So we pull out the tax table, and we find $71,800. $71,898 falls here, and they're married filing jointly, so they're in the second category. So that's $10,029 is their tax. 10,000. Yeah, $10,029. Okay. Alternative minimum tax, we're not going to worry about that. We add those lines together, these two lines, and you get $10,029 again. I'm going back to the problem just to double check to see if they get any of these credits. Okay, did they pay for child care? Did they put money into retirement contribution? You know, any of these things, and they're not qualifying for any of those. So we're just going to ignore those and bring down our $10,029. Then they're not self-employed, and they're not falling to any of these things, so we're not adding anything to that again. So this area subtracts, and this area adds tax. Okay. This is from your W-2s and your 1099s. So we need to go back to the problem, and the amount withheld for federal income taxes are those two numbers right there. Which is about $17,888. So that's how much tax they've paid, $17,888. This adds to paid tax. So if you qualify for any of these, earned income credit, opportunity credit, any of these things, it adds to your paid amount. So if you qualified for an earned income credit of $3,000, it would say you'd paid $20,888 instead of $17,000, that kind of thing. But we're going to ignore those for right now, because especially the most common of these, by the way, is why it's bolded, is the earned income credit. That one is income based. And so if you're a family of 3, 2 parents and a child, like family of 3, it's right around $40,000, $45,000. If you're not a family of 3, I don't actually know the numbers off the top of my head, but you can look it up to see if you qualify for it or not. Most people will not receive earned income credit unless they have a qualifying child. So pretty much you have to have a kid to qualify for this, or you have to be in extreme poverty. Now, $17,000 is more than $10,000, so they paid more than they owe. So we take that and we subtract the $10,029, and they get a lovely refund of $7,859. It's page 12 through 14. Odds. Which 39 through 45. Okay. All right. Tomorrow, review. Wednesday and Thursday is the test. The reason it's Wednesday and